inflation is going to be well in excess of that. That's what the gold market is saying loud and clear, except nobody is paying attention, at least, in the mainstream, if you understand basic economics and finance, which of course nobody does if you're in the mainstream financial media. And most of the mainstream investors don't really understand what's going on. That's why they're not buying gold and silver. That's why gold and silver, even though they're rising steadily, they're not like soaring, right? Because there is no panic to buy. It's a very orderly, methodical rise that's happening day after day after day with minimal corrections. Getting back to this BRICS summit. So it's being held in Russia, right? Which is supposedly, right? Oh, we've got sanctions against Russia. The whole world is supposed to be, staying away from Russia, blackballing Russia. They're the bad guy. Putin's the bad guy, right? Leave him alone. Yet you have all these leaders from other countries, from China, from India, South Africa, Brazil, Egypt, United Arab Emirates, Iran. All these leaders are now in Putin's, backyard. They've come to Putin, right? So they're obviously not boycotting him. They're all there. What is the primary goal these nations have? It's to distance themselves from the United States dollar. That is the main agenda. They want to trade with one another without using dollars. So when China buys something from India, they don't want to pay for it with U.S. dollars. They don't want to use the U.S. dollar in these transactions. And they don't want to hold U.S. dollars as a reserve for their currency. So they want to come up with another system that basically eliminates the need for dollars. This is a big, big deal because now more than ever before, we need China, India, Russia, all these countries to buy dollars, to buy our bonds, because we have bigger deficits than we've ever had. We have to sell more bonds every day, every week, every month than we've ever sold before. And we need buyers. But the buyers are saying, we don't want to buy. We're trying to figure out how to run our lives without your dollars, right? Without your treasury. So we're moving away. They're going to create their own system. I don't know how they're working. I have a pretty good feeling that gold is going to be a part of whatever they do. If they come up with a new basket or a new trade currency that they could use to settle all their deals, it may include gold and some other basket of their currencies, right? Their own currencies. The dollar won't be a part of it. The euro won't be a part of it, right? They're going to have their own trading block. And if you think about these countries, first of all, the population that you're talking about, I mean, when you get India and China together, I mean, that's a huge population. Those are the two largest countries by far in the world. But then, you throw these other ones in there and think about the resources. It's not just the energy that you have in Russia, in the United Arab Emirates, in Iran, but the minerals that you have in China, in South Africa, in Brazil. So these are resource intensified economy. And so this is a huge potential threat to the U.S. dollar and its place in the world. And we're ignoring that. And also part of the impetus to move away from the dollar are the sanctions against Russia. And it's not an accident that the BRICS summit is being held in Russia. I mean, they could have held it in any one of these countries, but they held it in Russia. That is basically a thumb in the eye of the United States because they're saying, hey, we don't care about your sanctions. You know what you can do with your sanctions? We're going to Russia. And by the way, the Russian economy is doing fine. The ruble is doing fine with all these sanctions. We didn't impose the economic chaos that we thought when the sanctions were first put on into Russia. But what we did is we galvanized all these other countries that don't want to be the next Russia when it comes to sanctions. So if they move to gold, which is why they're buying all this gold, we can't sanction their gold. If they own gold and store it within their own borders, we can't do anything about that. Yeah, if they hold U.S. treasuries, sure, we got them by the balls. That's why they don't want U.S. treasuries. But the problem is, who's going to buy them? Because we have to sell so many of them.
In recent conversations, Rick Rule explained the unusual dynamics in the gold market right now, underscoring a critical trend. Although gold has been rising in value, this momentum hasn't been mirrored in gold stocks or ETFs like the physical gold ETF GLD or other prominent products. Why? The answer is relatively simple yet profound. Central banks are driving this current gold bull market, not retail investors. Central banks buy physical gold, not gold-related stocks or ETFs. Rule emphasizes that while many investors typically see a rise in gold stocks alongside a rising gold price, this unique bull market is an exception, largely due to the purchasing habits of central banks. Rule's insights suggest that we're just witnessing the beginning of this bull market's potential. He explains that retail investors still aren't heavily involved in buying physical gold, nor are they flocking to ETFs like the Sprott Physical Gold Trust or the Perth Mint products in massive numbers. Instead, central banks have been leading the charge, buying up large quantities of gold as a strategic move to protect their reserves from the ongoing devaluation of fiat currencies, particularly the US dollar. The purchasing power of traditional currencies is under severe pressure, with fiat currencies like the US dollar losing value each year. For context, the US dollar's purchasing power decline is officially measured at around 2.6% annually by CPI, but Rule argues that this is a gross understatement. Key expenses such as taxes, gasoline, healthcare, and housing have risen far faster than the official CPI. These real-world costs, he explains, make the official inflation rate look absurdly low, and the true devaluation of the dollar may be closer to 7% annually, not the 2% to 3% figure quoted in reports. From an investment perspective, the central bank buying spree sets up a unique foundation for the gold market, one that Rule believes is not yet fully appreciated. The massive amount of gold being purchased is creating a solid base that, once retail investors enter the market, could propel prices significantly higher. When retail demand finally hits, it will be on top of a strong foundational support from central banks. Rule, with a hint of humor, refers to the potential for growth with the phrase, "You ain't seen nothing yet." The way he sees it, retail investors are only now starting to trickle in, as evidenced by unconventional players like Costco starting to sell gold. Yes, you read that right. Costco, one of America's largest retailers, recently introduced gold to its shelves, and it's been flying off at such a pace that the company is now expanding into platinum and palladium bullion. Costco's surprising entry into the precious metals market illustrates the beginning of what Rule calls retail participation, an indicator of rising public interest in precious metals as a hedge against inflation and currency devaluation. But this uptick in demand from everyday buyers has only just started. In examining why investors should view gold as an essential hedge, Rule draws a stark contrast between gold and its primary competitor, the 10-year U.S. Treasury. The Treasury's yield, he notes, sits at around 4%, which may appear attractive on paper, but he argues that if you consider the dollar's purchasing power is declining at a rate closer to 7% or higher, this return is deeply negative. Holding a 10-year U.S. Treasury at 4% means losing roughly 35% of one's purchasing power over a decade. In other words, the so-called safe investment actually guarantees a substantial erosion of wealth over time. Rule takes this a step further by explaining that for him, gold isn't merely a speculative asset that might climb to $2,500 or $2,700 per ounce. Instead, he considers gold a fear asset, a hedge he holds because he's genuinely concerned it could skyrocket to $9,000 or even $10,000 per ounce, as a reflection of deteriorating economic conditions and a sharp drop in the U.S. dollar's value. Gold isn't something he hopes will increase modestly. It's an asset he fears could surge dramatically if fiat currencies continue their current path of devaluation. As gold prices continue their steady climb, Rule predicts that this will serve as a leading indicator for the silver market. Silver traditionally follows gold in bull markets, and when it moves, it often does so with greater volatility and magnitude. Whether this shift happens immediately or in the coming years, Rule remains confident that a significant silver bull market is on the horizon, and when silver does break out, it won't be a subtle move. He recounts past bull markets like the 1970s and early 2000s, when silver saw explosive gains, drawing parallels to the current market landscape. If the factors driving the central bank buying persist, and if retail buying follows suit, we may indeed see those eye-popping gains again.